Good evening, everyone, and thanks for joining us on this evening's client webinar. We have to start obviously with some housekeeping that we do every month, or excuse me, every quarter. Just as a reminder, just silence your phones, and then over here to the right, if you're on a computer screen, there will be a chat box, and if you're on a mobile device like a phone or a tablet, it should be at the bottom of your screen. If you could just enter your questions there, we will get to them at the end of our session. The handouts for this evening's session are up under the handouts. Oh, somebody already clicked and downloaded up under the handouts tab on the top of your screen, top right. Again, just feel free to download those as you see fit. Because we live in a world full of attorneys, we do have to have some disclaimers here. Crain and Woolley and BFS Advisory Group are not affiliated. The mission of tonight's time is just general education only. So we're not going to get into specific advice like, hey, Sergio, I have $500,000. What should I do? We're going to be talking in generalities and answering general questions, but you will have the opportunity to make contact should you want a specific one-on-one later. But again, there is no obligation to schedule an appointment or purchase the service. Your speakers for this evening, a very familiar face, the managing partner of Crain and Woolley, Justin Crain. One of the highlights I'd like to point out, because he won't toot his own horn, is again for 2022, he was named as one of the top 3 estate planning attorneys here in Plano, Texas. It's quite a tremendous feather in his cap and for the firm. And then our guest speaker tonight is Sergio Garcia. He is a certified financial planner, and he was recently named a young gun by the DFW FPA and was named one of the best financial planners in D Magazine. So this evening we have the opportunity to hear from 2 men who really know their things, know their stuff, and I'm looking forward to learning a lot. Hi, Larry. So good to see you again. I'm glad you made time. Thanks for coming on tonight. And with that, I'm going to turn off my microphone and let the gentleman have the floor.
Great, thank you, Joy. So we're going to go through some legislative updates, a little bit of discussion about a bill that may become law, which is the Secure Act 2.0. I'll turn it over afterwards to Sergio to talk about some opportunities in a down market. And then just as a kind of repeat reminder, type in any of your questions in that chat box and we'll review the questions and address anything that we see over there in the chat box at the end. So for federal legislative updates, and there is a handout that you can download in the handouts tab. There were 54 bills that were signed into law in the second quarter of 2022. And if you want to read through all of those and click the links to download literally the entire text and all of the analysis on every single one of those things, click on the handout. You definitely don't want to sit here and listen to the discussion on all of those. And I didn't memorize all 54, but I did look through all 54 and we'll give you just a couple highlights here. We try to focus just on things that relate to tax and estate planning, and there wasn't a lot of change really in those areas. So this is not a long discussion in today's webinar. A couple things that stood out to me to include a couple slides on. There was a law that is now Public Law 117-125 on Courthouse Ethics and Transparency Act that I don't know if this is interesting to anybody else, but interestingly to me, requires federal judicial officers, bankruptcy judges, magistrate judges to start filing periodic transaction reports disclosing their securities transactions. So supposedly we're going to start seeing online publications of their financial disclosures, although you start reading into this and there's also ways that they can get around it and say, oh no, for privacy reasons, maybe we still don't have to post these things. So I'm certainly not an expert on this yet, but this is a new law that adds some additional reporting. Some of these types of reporting already existed for other parties, but you can read about this again in that handout and go and read the whole law if you'd like. And so that would fit into some of your financial law, and that one was just passed here on 5/13. There's another law relating to bankruptcy, and I don't specifically do bankruptcy, but that certainly would relate to your financial laws. And this was an adjustment to bankruptcy rules, particularly the amount of debt that someone is allowed to carry when they are going through bankruptcy, the debt limits that a person is allowed to carry. And bankruptcy is very technical as far as what amounts you're allowed to carry, what type of bankruptcy you're filing. But this increased some of the debt limits that people can have. And so perhaps this is going to assist some people for a period of time with their bankruptcies. And so again, if you want to read through the details and that excites you, you can click through in the handout and see all of the details on the increases. It got close to $3 million on some of those debt limits for a couple of years. Um, and then if you look through all 54 of those bills, there are a couple of them, HR 7691, S3522, that related to Ukraine. Probably not a surprise to anybody. Additional Ukraine Supplemental Appropriations Act, Ukraine Democracy Defense Lend-Lease Act. And then there, as always is the case, but there were a ton of different bills passed that gave names or changed names to public buildings, like a lot of post offices were given official names or new names. A lot of naming happens in a lot of the bills, and that's seriously probably 25 to 30. I should have counted up and given you the exact number, but a lot of bills named federal buildings going on in there. So to have a little bit of discussion on something that has not become law, but we've been really seriously looking at since March when the House passed a version, is some discussion on what a lot of people are calling Secure Act 2.0. And for those of you that have been coming to these quarterly webinars for the past few years, as a reminder, the original Secure Act passed in 2020 or went into effect in 2020 and changed the way that your retirement accounts, your qualified accounts work. Things like raising, your retirement age up to 72. And so now there's talk about making some additional changes. And this probably could be an hour-long webinar to go into all of the potential things that could be happening. And so I frankly reduced this down to just one slide and things that I think are most interesting and just my opinion, maybe most likely might pass. But to be clear for everybody, this has not passed as far as a bill into law. The House passed a version in March. The Senate has approved various things in committee, but it's not out of Senate committees. And so what the Senate's talking about is not even matching up with what passed in the House. So the Senate would have to pass something, then it would have to go back to the House. They'd have to both agree, then it'd have to go and get signed by the president. So this is going to take a bit. But what's going on right now in Senate committee, and some of this was passed in the House, some of it's just in Senate, are things like allowing money to be withdrawn without penalty in emergency situations. So, right now you might be aware if you take money out of a qualified account, you're just going to take a huge penalty on that. So it's pretty much never really a good idea unless it's just such a bad situation that the penalty is somehow still not worse than you having the money. There's some proposals saying that employers would be required to automatically enroll employees in 401k plans. Workers in most of these proposals would be allowed to opt out, but if they don't opt out, then they're just going to get a 401k plan. And for most of what I was looking at, it's pretty much going to apply to every company that has 10 employees or more. So basically, everybody is going to have a 401k plan unless they opt out as the employee. There are a lot of proposals to increase catch-up contributions, and there's a lot of different ages, and this is relatively complex. So I didn't really memorize every proposal because it's not a law yet, but there's all kinds of different catch-up contributions, ranging from in your 50s up to around maybe age 63 and up. And Sergio probably could talk about some of this, maybe even more detail out of his memory than I can. But increasing catch-up contributions that are allowed. And then raising perhaps the required minimum distribution age. So it just changed in 2020 up to 72. They're talking about making it up to maybe age 75 before you have to start taking required minimum distributions. They're saying in the House bill that did pass in March that would start in the year 2033 if this all became a law. The Senate bill is saying the year 2032. And they're also talking about phase-in years. So there'd be different years all the way up till 2033 or 2032, where it might be age 73 and then age 74 and age 75. Frankly, all of this would be kind of confusing. And for those of you that are in ages close to these ages, if this passes, you're gonna have to probably get some assistance to figure out, depending on where your birthday fell, when do your required minimum distributions start, which is the problem when these laws change, is everybody ends up with completely different RMD dates. And there's a lot of other proposals in there. What I'll tell you is this, certainly Sergio as well, and in the work he does, he's keeping his clients up to date. We also are doing the same. As soon as any law passes, and as soon as we get any closer, for example, the Senate perhaps actually votes and passes something in the Senate, we will be posting updates, blogs on the website, sending out the newsletter to all of you as clients. And if a bill is passed, not only will it be in our webinar that's as close to that bill passing as possible, but the same thing, it'll go on the website and be in the newsletter. So be on the lookout, but there likely will be changes to your retirement plans, your qualified accounts once again. So with that, I'm going to turn this over to Sergio to talk about opportunities in the down market.
Thank you, Justin. And so I'll start with asking if anyone is keeping score with the markets. You probably have noticed that the values are down, markets are down, maybe your accounts are down, and unfortunately, that's where we are in the current market cycle. There's been a lot of news about inflation, the Federal Reserve raising interest rates. There's issues happening because of the war in Ukraine. So there's a lot of different factors that have put us in the current economic and market environment that we're in today. So the fact of the matter is that we're in a down market and probably have been overdue for one for some time. Anyone who has kind of a general understanding of economics knows that cycles will happen. We'll be in an up market, and then occasionally we'll end up in a down market. We've been in an up cycle for a period of over 10 years, generally over 10 years. That puts us in a place that is not wholly in a place that we wouldn't have expected. However, that being said, and reality being what it is, that doesn't mean we stick our head in the sand but we address the current issue. And so what I wanted to do is take a look and then just talk a little bit about what you might want to consider, what you might want to think about, and possibly some things that you could do in a situation, in a market situation or a market environment that we find ourselves in. As a financial planner, my job half the time is to be a pessimist and to try to tell clients, well, if that doesn't work, this is what we have to have. So to have contingency plans in place. And then the other half of the time, my job is to really look for opportunities and say, well, if things going well, we could really do these other things. So I sometimes feel like I have two personalities, having to work with clients, but in order to ground everything for the client, I like to start with a financial plan. So when I work with clients, we work together, we put a financial plan together. And I think most people know what that means, but generally speaking, for anyone who hasn't maybe gone through that process, one, I would certainly encourage you to do it. It doesn't have to be particularly complex or difficult. It does take a little bit of time, and having guidance is extremely helpful. But it really sets context for how you're doing financially. It's the best gauge of your financial position and health. And it really helps answer the questions that I get from clients, especially in years such as this, where they see their account value and it may have dropped $50,000 or $100,000, and that can be very concerning. And so the question is, I'm down 100 grand. Is that okay? Am I fine? Well, without context, that doesn't look very good. And to be sure, no one wants to see their values go down. But when we have a financial plan, then from there we can say, well, yes, you're down, but your plan still is on track. You can still maintain your lifestyle. You can still meet your goals. And so that's really what's really important in this type of environment. That also allows us to reassess and have that conversation about risk tolerance and asset allocation. From the financial plan is kind of the big picture, and then we can get a little bit more specific about the portfolio management. And the reason I say now is a good time to reassess your risk tolerance is really because when the markets are up, it's much easier to be accepting of risk because everything just seems to be going up in the right direction. Everything's going up and up and up. You want to take on more risk because you want more growth. And then when things turn around, people find that they actually are less tolerant of risk than they thought they would have been. So I think now is a good time. If you have an advisor, talk to an advisor, or just there are a lot of tools online you can look to find and see, are you actually positioned in the best way possible that is comfortable to you, but also will help you accomplish your overall financial goals. And then what I'll spend the rest of the time is talking a little bit more, but specifically about what can possibly be done in this type of environment, this economic and market environment, because values, generally speaking, are down. Portfolio values are down. That gives us an opportunity, one, to do what's called tax loss harvesting. Ultimately, that just means selling off any securities, any investments that have lost in value, and taking that loss and netting that tax loss against gains. And this year there may not be many gains, but it is an opportunity to lock in some losses so that in future years, when there are gains, we can use those and then reduce our overall tax liability. And what that does is helps become more tax efficient at least from a portfolio management standpoint. If there is excess cash sitting on the side, and this may be the case because there was a property sold or business sold, and you happen to have a lot of cash, actually deploying that cash in a portfolio, if it's done reasonably and done appropriately, and it's cash that you don't have to have or don't mind putting up for risk, at least to some level of risk, utilizing that cash is actually something a lot of people in this environment would be well to do. Again, portfolio values are down because underlying asset value is down, which you may have heard the term. Things are in sale. And in that sense, yes, they kind of are. So if things are securities are lower in cost, you can buy more shares with the same number of dollars, and ultimately when the markets turn around, that puts you in a good place. Another way of saying that is buy low, sell high, right? So now the market is low, so now is the buy time. I'm overgeneralizing though, so there's a lot of different things to buy. Not all things are worth buying. So that's the caveat. But just in general, when markets are down, it's an opportunity, certainly, if there's cash available. And somewhat related to that is, and this is more of a kind of a less of a maybe a portfolio management, but more of a financial planning consideration or discussion, is wealth transfers. And again, because values are down, and this is probably something you have a lot of discussion with Justin, but you can transfer assets when they more of the same asset when the assets evaluations are lower. That can become a more complex conversation, but it's certainly a consideration to do something like this in these times like this. And then lastly, the one I'll spend the most of my time on is Roth conversions. And for anyone who doesn't know what a Roth conversion is, basically we take an asset either from a 401k, assuming you're not a participant, you're not currently working, and or from a traditional IRA, and then move it over to a Roth IRA, and that's the conversion. There's a consequence of doing that, which is paying taxes. and so there is some planning that must be done in order to make sure it's done appropriately. And it's not necessarily something that everyone should do. The situation has to be right for the right person to do it. And now, in general, is a good time, because again, it all has to do with what you're converting. You're converting investments which are lower in value because the markets are down, and so you're paying taxes on a lower amount, and so you can actually convert more by utilizing depressed portfolio values. So that gives us an opportunity. And why we would want to consider doing it, aside from the fact that markets are down, on the right side of the screen, you'll see. So this is just a chart of marginal tax rates over time and for varied filers, and you can see we're in a low tax bracket. So even outside of the fact that we're in a down market, Roth conversions generally are something to consider when we're in a low tax environment, and we are in a low tax environment. And so in the example on the left side of the screen, the ledger, it's a little hard to see it. I didn't realize it would be a bit small, but what I want to point to you is the tops on the left, top left, in the little red box where it says base fact. So that would be, it's an example of a client who has about $180,000 in gross income. So you can see what their taxes are. So this year it'd be about 18,000. And if we did a conversion of about 150,000, that would certainly increase their tax liability up significantly. And in this illustration, I did it over 2 years. So I did 150 this year, 150 next year. And so you can see for over a couple of years, their taxes from the left column to the right column goes up considerably. And so that's why I say you do have to have some planning done, and to have some calculations done in order to make sure it's appropriate. And there are a lot of other considerations. None of this is done in isolation, but by doing that, what the end result is on the bottom half of those ledgers there, where in the green boxes you can see, is on the left side, that would be the taxes over time on an annual basis. And they're higher numbers than they are on the right side. So one of the results of doing a Roth conversion is we're reducing money that's in other retirement accounts like an IRA or 401k. And so that reduces your future required minimum distributions. So under current law, it's at 72. So you can see at 72, that may change at some point, but currently it would be at 72. So in this illustration, the client here would start taking required minimum distributions at 72. But because we've reduced the amount of money that needs to be distributed out, we've reduced those taxes over the long period of time. So what we've basically done is exchange a couple of years of additional taxes to get many more years of much lower taxes. And then the last thing I'll point to is what the eventual result would be from a portfolio valuation standpoint. So here, it's a relatively modest. I'll give you a couple of assumptions here. Just over 6% return on the overall portfolio. So I'm not using anything particularly high or aggressive, but the result is, and this I'm looking towards the end of the lifetime for these clients. So we're looking at out to when they're about 95. On the left again is where if we did nothing, what the portfolio values would look like. On the lighter pink color, that's about 17 million. And on the far right, you could see by doing the conversions, that increases their overall portfolio values. And really the logic behind this is we've reduced taxes over time. So by reducing the tax drag, we've been able to increase the portfolio values over the long term. More importantly, is the darker shades of the two colors. So on the left, you can see there was some Roth assets already. So that's why there's about 6 million at the end of this person's plan. But by doing the conversions and allowing those assets to grow, you can see the result there is about 13 million. So that's an increase of 7 million in tax-free assets. And why that's important, this plays back into the wealth transfer and tax efficiency, is those assets then would move to whoever is the beneficiary as a tax-free asset, whereas otherwise, if it was still in the IRA, that gets inherited, and under the current Secure Act rules, that money would have to be out of that account in 10 years, and so that and all that. So any assets inherited in a traditional IRA would have to be distributed out in 10 years, and is also taxable when it's distributed. So it can be a very high tax cost there for heirs, and then under the Roth account, or from within the Roth account, those distributions would come out tax free. So we've really would reduce the taxes, not just for ourselves in the long term, but then also for our heirs. So it's a bit of a win-win in that regard. I have very much oversimplified the situation, but what I wanted to show is an opportunity that would be something to consider in any time when there's a low tax bracket, first of all, but even more so when we see that we have portfolio values are lower. It really gives us an additional incentive to really consider strategies which would be beneficial to us in either not just now, but also in the long term. So I'll leave it there. I covered a lot of information, but I'll leave it there to give us time. I think we have some questions after this.
All right, so if we want to go ahead and start putting in our questions in the chat box, we'll wait for a couple of seconds, and then if we don't have any, we'll just end our time together. So we'll wait for a few moments.
Yeah, I appreciate that, Sergio. And anybody has any questions, type those into the chat box. I think the interesting thing looking at the especially at like Roth conversions is if all the math immediately doesn't make immediate sense, my encouragement to everybody watching would be this is the kind of thing that somebody like Sergio can run some math for you and kind of give the exact explanations for how this could potentially fit into kind of your assets. And the reason for having Sergio on here tonight is just to give an illustration of this is specific to every individual, so it doesn't work for every single person. But should you be in a situation with an amount of assets and a tax bracket where this can work, I mean, I'm just looking at the slide that ended up on the screen here. I mean, you're talking about a total portfolio of 16.9 versus 20.4, right? Or looking at the tax-free assets, same type of increase. So it's pretty interesting. It's really a bunch of math, and you're looking at tax laws, and all of that is fairly complex, but it's an amazing difference, really. And I'd encourage you to talk to Sergio if you'd like him to run some numbers there. I've worked with him for a long time, known him a long time, and I don't often give those recommendations out because it's hard to find people like that. But I have worked with Sergio long enough that I can say he'll do you a good job if you want to talk with him, and if not, don't talk to him, right? I did see a couple questions pop up. So what did Sergio's 72 refer to?
Maybe that was referring to age 72. I think on the previous slide here, right where the green bars or green shading starts. So at age 72, that is under current law, that is the age at which your required minimum distributions would have to start, and that is applicable to any assets you have in qualified accounts. So in IRAs, if you still have a 401k, assuming you're not working, that at that age, there's a calculation that we would do, and then you start taking distributions.
Got it. And Larry, thanks for the comment there. The thanks for the information and to Sergio, myself, and the firm. Appreciate that. Well, I don't see any other questions coming up. I see we still have a few people on here, and so we will send out the video for you guys to rewatch. And saw one other thing pop up here. Does my total adjusted income affect my eligibility to convert to a Roth? That's a good question.
That is a good question. No, actually, it does not. So anyone can convert. There used to be an old rule. It no longer is around that that looked at your AGI, your adjusted gross income. That's no longer the case. Anyone can convert regardless of your income level. And any amount for that matter. So there's no cap on the amount you can convert. Just know that every dollar you convert is a dollar of taxable income. So that's why it's also important to consider the full facts. Increase your income could have a lot of impacts. I didn't get into a lot of details here, but by increasing your income, it could push you into another tax bracket that could impact your tax picture, increase your capital gain taxes, increase other taxes as well, net investment taxes. So there's a whole lot of moving parts here. So one thing you do tends to have an impact on other things. So that's why the analysis is important.
One of the things I know Sergio mentioned this, but I'll kind of maybe say it in the way I would say it. Sergio's pointing out that essentially there's a risk to doing the conversion in the fact that if you've deferred taxes and you're going to convert out assets, from a qualified account, you're going to have to pay all those taxes. I don't know how much these charts, that we're looking at make sense to a person who doesn't look at them all the time, but I've seen some of the reports that Sergio puts together. He would run the numbers for you, all the scenarios, and make sure that essentially the conversion is optimized. If there's no scenario that actually makes sense for you to do it, Sergio would tell you. If there's scenarios where it makes sense, you run the numbers and you basically find the sweet spot and say, hey, you pay a lot of money for 2 years, but then look, you have a 20% increase or whatever it is, over the next 10 or 15 years in your assets. So I think Sergio said it well, but just to kind of state it in the words that I'm thinking, that's where these reports are really kind of fun and interesting, especially if you run the numbers and happen to have the sort of perfect asset class and tax brackets that you can have that increase. If you've never run those numbers before and happen to find that you have that type of scenario where you have a positive plan you can implement, that's a pretty exciting thing to find out. So anyway, just throwing that out there. Are you seeing these, Sergio? I was reading them off, but
yeah, I can see them too. So yeah, there's a question on the tax form. If you do a Roth conversion, what you would receive is a 1099 R, I believe, and that would give your tax preparer or yourself the amount of the conversion. So again, since every dollar that's converted is taxable income, it's considered to be taxable. So if you convert $100,000, you would just have to recognize $100,000, even though it's actually went from one account to the other. So you would get a 1099, and then you would record that on your tax preparation, your tax filing. Let's see here. Convert from a conventional IRA to Roth growth. What are you predicting? Yeah, in this case, I'm using the same growth rates between the two accounts. So overall, the portfolio in this illustration, it was about 6%, a little over 6%. But I am not, to make things simple, I'm not changing the growth rates between between the traditional IRA and the Roth IRA. However, that being said, there's more nuance there, and depending on the goals for the client, oftentimes most of our clients, at least the ones I work with, when we do Roth conversions, one of the big reasons for doing the Roth conversions is because we know those assets will be allocated to their heirs. That's the intention. They really don't intend to ever use the money themselves. So then what we would typically do is invest those funds more aggressively, because we've essentially extended the time horizon for that. So that gives us actually an opportunity, an arbitrage opportunity, where we can take money at a lower return and then reinvest it in a more aggressive fashion. So that even would further make this picture look better. But I didn't want to. You wouldn't know that by looking at these charts, so that's why I didn't want to like be overly positive in my illustration here.
Hey, Jerry, to answer your question about the handouts, Sergio's charts are not included in the handouts as they were just as an example. So we wouldn't want somebody to take them and use them to make specific decisions. We would just really encourage you to go talk to your financial advisor or reach out for a consultation.
All right. So another question. Okay. We got a question. Once you have a Roth IRA, can you use it as a step-up IRA?
I'm not sure I'm familiar with the term step-up IRA.
Yeah, I'm not sure what that would be either.
If the question is about a step up in basis for assets, if that might be the question, in that case, the answer is no. So any assets either within a traditional IRA or a Roth IRA, or for that matter, it was held over in a 401k, none of those assets receive a step up. However, if you have money in funds in a Roth IRA, there is no step up, but then the heirs who receive it as beneficiaries, they receive the funds. They can draw out those funds tax free. So
it's kind of like
effectively it's the same reason. It's the same effect as how you can step up in a taxable account.
Yeah.
I hope that was the question. I'm not entirely sure, but I think that's the question.
Yeah. Good questions. Joy, there will be a link we'll send out, I believe, with the presentation again, so you guys will be able to watch that again. So you'll be able to see the slides, to kind of the question about the slides, just not as a handout. So you guys will be able to see this again. Unless you catch me before we click the off button, we'll go ahead and sign off. Want to thank everybody for showing up. Appreciate your time, and we'll do this again here next quarter. Thank you, everybody.